one more action-packed session, so don't go anywhere. I'd like to invite to the stage, super quick. Yeah, that's okay. I'll get the chair. Steve Grubmier from Asia Pacific Partnerships Director, MRI. Where are you, Steve? There he is. Frank Greeff from Domain. Yes, at the front there. Eddie Cetin. Have I pronounced that right? ReapIT. Matt McGowan. Yep. Eddie is dressed up as Matt today. And last but not least, and give him a big hand, all of these guys a big hand, but in particular, Stuart Dullard from Ashurst, one of our major sponsors. Please, Stuart, welcome to the stage.
Okay, the last session of today is how to sell your PropTech to big business. My first questions are to Steve, who's here from MRI Software.
One of those.
And I might just combine the first two questions together. The first question is, what are the advantages to MRI Software from growing by acquisition? And is there anything in particular that you're looking for?
Thanks, Jen. I think, let me start off by thanking everybody for being here today. Great initiative. I think for MRI, being a recognised, region and global PropTech business, a number of things that we look for, particularly with a focus on our customers and their customers as well. And I think what we want to do is improve their productivity, their day-to-day operations, but also create a business for them where they can grow and scale faster. And the way we do that is one of three ways. We do that by building new tech, and we partner. So one of my roles is to look for new partnerships, and if not, we acquire. And the reason why we do that is I think it gives us more scalability as well, to grow with our customers, to fulfil needs across the business as well, but also to drive new initiatives within the real estate sector as well. And I think staying up to trends, we can't keep up. When you think about MRI, it's quite a large organisation across, EMEA, APAC, North America, 250 odd brands. We can't scale that quickly. So sometimes acquisitions is the best and the most natural thing for us to do. To your second question, I think what are we looking for? There's a number of different things that we look for. MRI is made up of a couple of different business categories. It's not just residential. In this space, I think everybody knows MRI, in a residential real estate space. Think of, in Australia, Box and Dice, Vault, Property Tree. But in our other marketplaces, we're more familiar in North America for our commercial side of the business. So acquisitions for us are mixed and varied. We look for businesses that complement our services, that give us the ability to offer new services to new categories and to new marketplaces as well. So I think it's a bit of a mixture. Ideally for us, they're out of a startup phase, they're developed, they're generating revenue, they have a product fit, they're a good partner in some cases, or we've got experience working with them in collaboration. In fact, one of our most recent acquisitions wasn't a PropTech. It had no IP, but it helped us scale our teams to be able to deliver services faster to enable us to scale faster as well.
Great. And do you have a typical process? How do you find your potential investee companies? Is there any typical due diligence process? And how should people get in touch if they'd like to explore the possibility of a deal?
Yeah, acquisitions. It's a rather large team. So we've got a global team that look after our mergers and acquisitions. And I think, we're lucky because we can remain impartial to that. So local stakeholders aren't always privileged to be a part of those conversations. I think it removes any influence as well. What we do is we go through a whole mergers and acquisitions process. It's probably a 19 or 20 step process. I won't go through it today, but I think the first thing is to identify, what we are looking for. Then what we do is we maintain progress through that stage by stage process, and what we do is there are corporate standards that we need to meet. There's negotiations, but product fit is the most compelling product.
Great, thank you. Frank, big news
Hello.
last year. Domain in the Fin Review, buying Realbase for $180 million cash and an earnout of $50 million. My first question is why? Well, it's a question of questions. Okay. My first question is why Domain? Who approached whom? And were you running a process? Were you officially for sale?
All right, good questions. I like it. I'm going to mix it up to keep the crowd enthusiastic. Today we've got the graveyard shift, but I think it's one of the most important conversations talking about cash. So let's start with the who approached who, which wraps into the process piece. So it's a really interesting story. I had probably a bit of a delusional view of my selling capability, and I thought I could go sell my business myself. I thought, hey, I can sell to customers, I can sell subscriptions, $249. What's the difference, right? What's the difference? And so I went out actively, and like I do, John put something up today, which was around the Energizer Bunny, and I understand what that feels like. And so I took this view that it had no process. I approached a bunch of people and I said, this thing's going to be hot, you got to move fast. And a bunch of people just kind of dropped off, and they just said, it's haphazard. And then one day I got a LinkedIn cold message. And so this, my biggest key point for everybody here is the deal size and the commission that happened all was done from a LinkedIn cold message. And it was an amazing man by the name of James Yee from Adastra. And he says to me, Frank, I believe that Domain is the right purchase for your business. And I think I can get you exactly 180 million, word for word. Would you like to have a conversation? And I was like, at that time, I'd already spoken to Domain, and they said, no, thank you, good sir. So I said, well, what's the harm, right? And so I had the conversation. I explained to him my amazing sales strategy, and he said, Frank, with great respect, you're doing this all wrong. We need to run a process, and you're selling yourself. You need to sell their strategy and how you fit into it. And I think that was fundamentally the biggest shift. And so then to your point, who approached who? Initially, I approached in a backdoor roundabout way, Domain, and got in front of Jason Pellegrino, amazing man, but I was unsuccessful. So we went through a process. The process was probably one of the most grueling processes of my life. At that time, my wife was pregnant with our first son. It was a 9-month process. It was just myself and the CFO. I was trying to protect the business, not get all wrapped up in the day-to-day. And I had what I would consider a couple of very close to my version of a mental breakdown. And on the final negotiation for the Domain deal, it was at, I like to tell this story, it's a bit of fun. I was at the birthing class, the final birthing classes with my wife, right? And there's a moment in birthing class, if anybody's been, where they say, hey, husbands, now's the time, we're about to show a video. If you feel uncomfortable, you can stand up. And obviously all the husbands like, no, not me. And I looked at the time and it was 1 minute until my final negotiation. So I'm so sorry, babe. I've got to leave. And she said, everybody stared at me. And for 4 hours in the car, I was doing my final negotiation. Now to your last point of your question, why Domain? There's two parts. Number one, I had a view which was we had built a business which, in my opinion, had a great culture and people were enthusiastic to be there. And one of my things I was always really big on when I was CEO was I want people to be proud to work here. And so my starting position was when this sale happens, when they go to a barbecue, will they proudly tell their friends we were acquired by Domain? Or will they be slightly embarrassed because they weren't very cool and they didn't align? And so I guess the piece there is cultural alignment. So like the way in which we saw the world, the way in which we treated our team members, the enthusiasm and excitement we had to do our day-to-day, did they fit that? And that was a huge checker box. John Fung, during the deal, said to me, Frank, let's go for a bush walk. And that was part of the Hearts and Minds campaign. We went walking in a bush for an hour, and I thought this was pretty cool. And then the final piece is around the proud, but then also, do the products make sense to each other? So the products had to make sense. There's a number of people that were looking to do the acquisition, which there was either no overlap or too much overlap. Domain, we saw it, the analogy was we were the missing puzzle piece to add to their very large puzzle, and vice versa. Long answer, apologies.
Okay, all right. I mean, Domain had to do a rights issue to raise the $180 million, and obviously they had to make a case to their shareholders why this was a great deal. I'm curious to know, what case did you have to make to your shareholders and other stakeholders as to why this was also a great deal?
So I had the total share pool of Realbase was 10 stakeholders, all original founders and some early stage employees. My approach as CEO and the approach in our boardroom was kind of relaxed, was constant communication. So I was managing those 10 stakeholders at all times through the entire process. So I think the why domain was, hey, this cultural piece is going to be really important because some of the shareholders were at some stage going to look to exit. And did we want to have spent, for myself, it was 10 years. For the company we merged with 20 years. Did you want to spend 20 years working on something that's going to go up in smoke? Yes, you got your cash, but is that something you're going to be proud of? And so that was the piece that they had to trust in me, and I had to deliver them the why I believe they were the right company for the future. And that was probably my main piece, is really talking about this is the reason that it's the right partnership, and the clients will see that, and if the clients see it and our team sees it, we're going to be in the right way for success.
Okay. Now, Realbase was itself the result of a merger of CampaignTrack and RealHub in 2020. Now that you've done the big deal, with the benefit of hindsight, is there anything in particular you did right when you merged CampaignTrack and RealHub in 2020? Or was there anything you would have done differently?
Great question. So what did I do right? The single-handed best thing I did, I'll give myself a slight pat on the back for this one, was the negotiation for the merger. For context, CampaignTrack was 8 times the size in revenue, 5 times the size in profit. The negotiation position I went through was 2 things. Number 1, it had to be a 50-50 merger, and number 2, we had to move fast. Now, the 50-50 was absolutely outrageous that I could pull that off. The move fast was very intelligent, but very dangerous. And so my view was, I didn't know them. I hadn't yet built a level of trust. So if we move fast, what it means is I can't be strung along and then the rug be pulled under my feet. However, going through a true acquisition process and going through 9 months of grueling detail, you realise there's a lot that gets uncovered during that, and a lot of very scary moments. So this conversation could be very different. You could be asking me a question at a very failed merger on the side of a cafe, and I'd be telling a very different story. The reverse is, if things were uncovered and we went from a conversation to 6 weeks later, we were merged. Our accountants and our lawyers have said, "You're crazy, Frank," and they were rightly so saying that, but it turned out great. So my thing would be, make sure you appropriately manage the due diligence process, because that could have gone wildly wrong.
Wow, 6 weeks. Wow. Have you heard of anything faster than 6 weeks? I don't think so.
No, definitely not. But it's funny you sort of talk about the people and the strategy and the product fit, because I've been doing deals just for 20 years, right? And people think about price and earnouts, and we can talk about all of that. There's all these legal mechanisms that the lawyers put in and the investment bankers negotiate. But of all the train wreck mergers that I've been involved with, I touch wood, it's not the legal and all of that. It's when, the frenzy of the deal's done and people are in the office on a Monday and they've got to work with a bunch of new people. And I think if that senior leadership level, if the people don't get on, if they don't share a vision, if they don't respect each other, there can be real cracks, and that can go poorly. And I've been involved in a few of those. And often I think founder-led businesses, when they're selling, there's a lot of cash on the table. It's a good opportunity. Yes, there's some earnout, and particularly in volatile capital markets, the alternative to selling can be risky, right? Like, how's my runway? Am I profitable yet? How's it going to go? But I also think that they can forget that, well, they're in the business, maybe there's an earnout, they need to stay for the earnout, and they perhaps underplay their strength, that if I sell this business and they don't keep me happy, then this is going to be burning the upfront payment for them. So they don't want that either. So I think particularly in the last 18 months, there's been a dynamic, because of the way that capital markets have been playing out, that there's been a lot of negotiating power on the side of buyers. And we act buy side, sell side, as you would know from the buy side. But my practice is predominantly, acting for founder-led businesses, and I think some of them are feeling that desperation in the market and not recognising that that cultural alignment and the importance of the senior executives to making the deal a success for the buyer.
Thanks, Stu. Matt, you might need to grab a mic.
Thank you.
It was announced in March last year that ReapIT, backed by Excel KKR, had acquired Console Group. could you please start by explaining the relationship now with ReapIT, AKKR and Console?
Yeah, sure. So I'm Matt McGowan. I'm filling in for Eddie. Look, KKR is a private equity company that primarily backs founder-led businesses. That's their bread and butter. They take category leaders in certain verticals, PropTech being one of them. So they're the investment arm. Their lead investment into PropTech was ReapIT in the UK. It's a very large business. It services the top end of the market in the UK market. Console is a subsequent acquisition within that group. So ReapIT being the lead company, we kind of fall under ReapIT. Console becomes a product of the company ReapIT, as does AgentBox, IRE, and AgentPoint.
Yep. Great, thank you. So why was ReapIT the right M&A partner for Console Group?
Yeah, look, I think part of it was we'd just come out of COVID. We just built a brand new product. We were acquiring customers very quickly, and we were looking for that, that next level of growth. The stable in ReapIT was really impressive. They had already acquired AgentBox, and at that time we were looking to, we were asking ourselves the question, how do we accelerate growth? And we were thinking about building it ourselves, moving into the CRM space ourselves. So when we were approached by AKKR, and we'd had a relationship with Eddie and AgentBox previously, it was just a natural fit. And I've been both a founder who's sold entirely out. I've also been a founder who's taken capital, and this was almost the best of both worlds. We were getting capital to accelerate growth. It's like petrol for a fast-growing company. And we had a synergistic revenue opportunity with AgentBox. So there was a lot of, we've talked about product market fit. That's really a really big thing. AKKR runs the due diligence, and through that process we got to know the Eddie and his team a little bit further, and the cultural fit was quite obvious as well.
Right, and having gone through that process now, is there any advice you would have for any PropTech founders who are interested also maybe to approach ReapIT and follow in Console's footsteps?
Yeah, I think we're really focused on taking category leaders. So, and a category is, in some ways self-defined. It's also market-defined. But, you need good product and business fundamentals. You need to be, owning your vertical, or, one of the top 2 companies in your vertical. And if you're not, there needs to be a pathway to getting there, and it needs to be able to be communicated to a buyer. Generally, and because capital markets have changed recently, we are an acquisitive business. And there is, it's probably swung a little bit to the buyer's side. Efficiency is now the new growth, and we're looking for businesses that are profitable, growing, and own their category. And if you meet those 3 requirements, you're a very attractive acquisition opportunity. And also, we're also looking for people who have a vision beyond the exit. We're not a company that takes 100% off the table. We like founder-led businesses, and we like businesses that are in there for the long run.
Fantastic, thank you. Stuart, I'm curious to know from your perspective as a lawyer, we've got a mixture here of some VC-backed, some minority. What differences do you see as a lawyer? Because deals are often done in stages. And what difference is it if you're negotiating with a strategic party rather than a VC?
Yeah, well, it's a good question. I think a lot of companies, as they grow, they'll take on venture capital or minority investments. So that's a sort of far more common path for high growth technology companies. And I think one potential error that people make, particularly in the founder-led business, is, I've done a couple of rounds of funding, maybe in this company or maybe in a past life. So, an M&A exit can't be too different, right? So, particularly in the last 18 months, I've acted for a bunch of companies where they're actually considering between, well, maybe I'll take another 5 million. But if someone comes along, I might sell. And I think they conflate the level of rigor and the time involved in a VC or a minority investment and an exit. Another error they'll make is if they're considering both of those, and if they're not yet profitable, it can be quite a risky play to say, well, I'll turn down this minority investment to pursue this bidder because both of them will work out in 3 months. Now, in all likelihood, the buyer will take longer. And if you're running out of runway, if you're not yet profitable, that's a precarious position because if it fails, you're in a lot of strife. But also, even if it doesn't fail, as the clock ticks along, the buyer is becoming, in a much stronger position because they're looking at you going, well, if you don't accept my terms, the downside, the alternative for you is not fantastic. So I think, they're the kind of, that's a high level. But when you think about it from the buy side, a minority investor is keen to get involved. They want to provide some growth capital, and they're backing the founder to grow the business. But taking a big step back, those VC investors have got a portfolio approach, right? They'll back 5, 10, 20, 50 companies, and they'll really rely on 1 or 2 outliers to get the IRR of their fund above their performance target. They don't need 19 out of 20 to knock it out of the park. So they just need to back a few, and they know that most of them won't provide abnormal returns. But with a buyer, whether it's a sponsor or a sponsor-backed company or a trade buyer, they're all in. Like they're not buying this and buying 19 companies and hoping that one of them turns out. They're paying real money for this business, and they really need it to work out. And their board will be grilling the deal team as to whether the deal still makes sense. So the level of rigor that a buyer for 100% or a controlling interest will apply to an acquisition versus a VC tipping in 10% of the company is quite a different investment proposition, and that'll play out through the deal dynamics as to the level of rigor and the time and the effort it will take. And to give you a sense in just terms of the legal side of things, like we might, depending on the size and complexity of the deal, but say a large fundraise might be sort of $50,000 worth of legal work for a Series B or a Series B, like a proper deal, and then the legals on an exit between 1 and 200 million would be 10x that. So there's 10 times the hours spent by the lawyers doing an exit than there is for an investment, just to give you a little bit of the quantum as to the diligence of the transaction documents and the completion process.
Thank you. Now, as I mentioned before, with Frank's deal with Domain, or Realbase's deal with Domain, there is a $50 million earnout in there. Could you explain a little bit more what is an earnout and what are some of the examples of hurdles that might be agreed to?
Sure. I think so. Just the economics of it. It's basically the founder saying, my business is great and it's growing. It might have a certain amount of revenue and profit this year, but next year it's going to be even more. And look, the year after that, it's going to be even more. So my company might be worth 100 million today, but I reckon it'll be worth 150 million next year and 200 million next year if the growth keeps going the way it is. And the buyer says, that is fantastic. That's great, but I'm only willing to pay you $100 million because today's today, right? So you've got a malalignment or an expectation gap between the value of the business for the seller and the value of the business to the buyer. And if you could only pay 100 cents in the dollar on completion, you may not get the deal done because there's just a malalignment of value or a different expectation gap. So an earnout is just a mechanism to bridge that says, okay, well, I'll pay you your 100 million today, and if you hit those targets, then I'm willing to pay you that extra money over the next typically 2 or 3 years. But then the buyer will also cotton on and say, but I want you to hang around. Like, you're not getting this money if you just give it to me and then I do all the work and get it there and you get your extra $50 million in that case. So there'll be some hooks into keeping the founder there. If the business just plummets and doesn't hit those targets, then you don't get the earnout. What are the common earnouts? They're really varied. It depends on the way the buyer will value the business. But the easiest ones are the top line. So revenue's the easiest because everyone knows how to calculate revenue. But once you scramble an egg, bottom line becomes a lot harder. So EBITDA's a bit harder than revenue and NPAT's sort of even harder. But there can also be, particularly with earlier stage companies, more business aligned metrics. I'm doing a deal now where there's product uplift and product integration as triggers for the earnout. So they're the kind of key things to think about. The only other one, just when people are thinking about this, because I think it's in 90% of deals in this space, would be it's great to agree the earnout and for all the reasons that people are aware of, but then during that earnout period, the buyer needs to give the founder the autonomy to run the business, because otherwise the buyer can run a business in a way that may not maximise the ability to do that earnout. So it does add some deal complexity, but I think overall it's worthwhile for solving that problem. I'd be interested to hear sort of how you thought all that played out.
Very good. Well, I'm still here, so that's positive. So one thing I just actually want to double back around and just back your point there is, I think one of the biggest things that stood out to me upon the transaction was the cost of the unknown. And I think I had zero idea, and let me explain it to you. So going into the deal, like I said, it was a 9-month process. Between the legal, the financial, and the tech due diligence, we were $3.3 million in the hole, with zero view that you were going to be successful. Because you're going to a transaction, then people are coming to the party, then you're negotiating. So you have to do all of what they call vendor due diligence, which is upfront work. And so I just think that's a really important point, because it's something I was like, if I knew, it would be amazing. But to your point there, the earnout piece is, it's exactly like you're saying, it's varied. The only thing it's interesting that you mentioned there is when we had KPMG look at it, they said for earnout can't attach you, the founder, to it. So there can't be a mechanism. Now, it could be incorrect, but the mechanism, they said they can't attach you to it because then it's no longer a capital gains tax. It's therefore an employee tax. And then you'd be disproportionately affected by like 25 to 30 cents on the dollar. So then it has to be other ways in order for you to kind of want to stay, I guess, is what happened to us. In terms of mechanics, you're spot on. It was revenue as well as EBITDA, and having both of those meet. But then things you can do is things like rollover clauses. So something that we had was, well, if the market drops, and that's not our fault, well, the following year, can we claw it back? And so there are different mechanisms there, and it's all a negotiation. That's the big thing, is many hours, many lawyers, much time. You get there.
Frank, while you still got that mic, final quick tip for long-term success.
Oof, love it. Okay, I got 2 ones. So first one for me is, I think when you start the business, when you start whatever business it is, starting with a position that when I sell, in my opinion, is not a very strong position. And I'll say that, like, I'll explain, because you can go, I'm going to do these things, so one day if I do sell, it'll be great, and that's fine. But if you have the view that when I sell, people will feel that. They'll sense that from you, whether it be your team, whether it be your customers. And so, like, I think what we were really lucky is we're long-term mindset. Like, we're long-term, and so the customer felt that. Our clients felt that, and so then it makes everything much more smooth sailing. So that's probably one. The second one I would be is understanding the process as best you can early and upfront is really advantageous, because the reason our deal was so expensive was because it was messy. We had messy companies, messy organizations, 12 entities, all this stuff. And we hadn't kept track over 20 years. We hadn't thought of the selling process. So therefore, the selling process was very cumbersome. And the last one, I know you said quick, but I'm not that quick. The last one is around speed. I'm so passionate about speed to execution. It's almost everything. And so, like, when you're starting a business, everything you do, it is a race. You do it at pace. You will be disproportionately over time so much better off. And the way to think about it is it's all compounding. It's a compounding effect. If you can very quickly test a market, iterate, get customer feedback, get the new customer, you can very quickly move forward. And we did that to the point where we never actually raised capital. So we just sold, I sold at the time my DJ turntables for $2,000, and then the next time was my investment property. We just sold everything we had, because we were moving at pace that we had a view that we had to be profitable enough to pay for ourselves. But that only happens because we went from idea to create Real Hub to launch to our market. So the first technology piece was 6 months until we first got it in people's hands. I'm seeing businesses today that are 3 years in idea. That scares me.
Steve, kind of the same final tip question, because I know when you're in the middle of a deal, everyone just wants to get over the finish line, right? They want to get to that final signing ceremony. We just want to sign, pay the money. But what would you recommend people think about? Ms. Stuart mentioned a little bit before, tips for longer term success of a deal.
I think understanding the culture of the business that you're merging into, and also anticipating some of the challenges with that acquisition merger, particularly like if you're talking to customers, like communication is fundamental as well. How you're showing up, I think, at a senior leadership level, the communication that you share down, but also within the huddles that you have. I think it really comes down to, for me, working with some of the teams, most recently with the Proptech Group acquisition, making sure that we're keeping key stakeholders engaged, the different entities that are exiting the business as well, like how they exit the business, what communication we're sending out to their old staff, their old team members. I think the process is never really over until you have one fully embedded, billing system, all operating off the same software, like Salesforce. It hasn't been completed until you get to that stage, and I don't think at MRI, we still have some gaps, but I think we're working through to close those. But I think like it's for the exit of like if you're the founder of exiting the business, I think it'd be a successful merger would be, or acquisition would be, being there for your team after you've left the organisation, but also making sure that you've set that business up for success to continue to serve those customers in those segments, how you saw it as a part of a founder or as before you actually sort out.
Yeah, thanks for that, Steve. Matt, what would you observe?
Yeah, I think I might have summarised the two comments before. I think when we're going into an acquisition, we're really looking for companies with a long-term vision and not running out of steam. We're looking for people who, honestly, they could keep going without our investment. They're really that's a really strong company. I think going into the deal, there can be a bit of deal fatigue. So it's how do you keep the momentum through the deal, because there's a lot of reasons a deal can fall over. And really you want the company that you're acquiring, or if you're the company being acquired, you actually need the energy to come out and continue to grow. They're probably the two big things. Integration of culture is really challenging, and really you don't really know somebody until you're actually in there together, and you find out a lot of things quickly. Like, I think one of the things that we try and do is be radically transparent. Now, all groups that come together, Storm, Form, Norm, there's a whole process, and two companies merging together have to go through that process really quickly to achieve the deal outcomes, because the deal team does come under pressure. There's always someone doing an evaluation after you've kind of gone through the process. They're probably the three things. You want energy coming into the deal. You do want to do it quickly as you can, because you need that deal team to come out of it, and you need your merged company to be better than you were going in. And I think cultural alignment, or at least vision alignment, is really, really important. Otherwise, acquisitions aren't successful.
Thank you. Stuart, you made some great comments on this point earlier. Any final tips?
Look, I think just at least from a legal perspective, I agree with everything that's been said, and that resonates with deals that have gone well and not so well. But just making sure particularly with earnouts and the contracts, making sure the interests are aligned in a really sensible way. One thing I've seen, again, over the last couple of years is with an imbalance of power, some people have taken advantage of that, buy side, sell side, and sort of screwed the dial so hard that someone just feels like it's not a fair deal. And I think, get the best deal you can by all means, but I think cutting a fair deal, and even to the extent of leaving a few crumbs on the table so the alignments are fairly set, are setting yourself up for success, rather than sort of having a purely adversarial approach to the negotiation. I think the way you present yourself through the negotiation with transparency and integrity and a sense of fairness, rather than just winner takes all, can be really helpful. And I think it's also important that the buyer or the founder picks a deal team, whether it's lawyers or investment bankers, and really instructs the deal team that, yes, we want a good deal, but we want to walk away from this feeling like we were fair, we did it with integrity and transparency. Otherwise, you're taking a first pretty material misstep.
Yeah, absolutely agree. Wonderful. Well, thank you so much for actually being really honest and real. That was a great discussion. Thank you.